Hey, everybody. Welcome to another episode of Swan Signal Live. I am your host, Sam Callahan. I'm the lead market analyst at Swan Bitcoin, a Bitcoin financial services firm. Before we get started with another great episode of Swan Signal Live, I want to bring up Pacific Bitcoin, which is the festival that Swan puts on every year in beautiful Santa Monica. If you use the promo code SIGNAL, you can get 10% off your tickets today. And if you use Bitcoin, you can get an additional 21% off. That's a total of 31% off if you go to Pacific Bitcoin right now. Those tickets are fully refundable by February 1st. And so if you're just on the fence about whether you'll be able to go, there isn't that much risk just buying in those tickets right now and locking in those cheaper prices. It's a great festival, so check it out. This show is brought to you by our partners, powered by Marathon Digital Holdings, the most technologically advanced publicly traded Bitcoin miner and the second largest of Bitcoin out of all those publicly traded companies in North America. Marathon's primary mission is to enhance the Bitcoin network by sustainably increasing the amount of computational power or hash rate that helps make Bitcoin the most decentralized and secure monetary network in the world. And on this episode, we got a very special guest. We actually have the chairman and CEO of Marathon Digital Holdings, Fred Thiel, is coming back onto the show. So, Fred, welcome. Thank you for joining us.
Great to be here.
Yeah, so I wanted to open up maybe the most top of mind item right now is these ETFs that just launched. And, one of the things that I've noticed is you've seen kind of other investment vehicles that might have been used for Bitcoin exposure kind of starts to suffer a little bit as there's been a shuffling around. Like you see this in MicroStrategy, some of these publicly traded Bitcoin mining stocks and these ETFs, Grayscale. How are you looking at some of the performance right now, and how do you see that kind of playing out in the coming weeks?
Well, I think you see partially some reshuffling. You're seeing people who had bought into Grayscale at the discount, whether it was 40% or 8% or anywhere in between. They sold out of Grayscale and rotated their money into other lower fee funds. Grayscale is still charging about 1.5 points, so 150 basis points, where others are charging, either free for the first 6 months or somewhere between 25 and 50 basis points. So you're seeing some rotation. I think you haven't really seen institutional interest start yet. That's most probably going to start coming towards the fall once people see these ETFs stabilize. People are still trying to figure it out. Normally there is a launch of an ETF for a particular commodity. Here you've got all of a sudden a whole graduating class, if you would, of ETFs, and people are still trying to suss out the pros and cons of each one. Obviously, BlackRock has garnered a large percentage, as has Galaxy. So I think what we're going to see is some balancing out over time. I don't think it's really taken a lot of people who were before spot holders. I don't think necessarily Coinbase has lost a lot of customers to these ETFs at this point yet. The whole real objective here is to attract a new class of investors to Bitcoin, people who are, either RIAs or customers of RIAs rather, institutions, pension funds, 401ks, and the like, who don't want to have to deal with custodying Bitcoin. They don't want to have to deal with all of the issues of holding Bitcoin on exchanges or trading it. They just want to be able to buy it through their normal broker. So I think this is something that's going to take a little time. What has been very positive, though, is the volume of trading was very substantial. It's one of the most successful launches of an ETF category in history. And if you just look at the sheer volume, it definitely exceeded, the launch of gold ETFs. It's taken away also some, obviously, funds from the futures ETFs, but you're also seeing a whole slew of new participants applying for things like short ETFs. So to be able to short Bitcoin, to be able to do leverage on Bitcoin, to be able to sell calls on Bitcoin, things like that. So you're going to see now a whole family of funds come that will allow more and more people to essentially paper trade Bitcoin without having to actually hold it. And
Do you think
all that bodes well. So
you think that bodes well? I was going to ask you, do you think that's a pro or a con that we're seeing these kind of derivative products start to come out in the woodworks after these ETFs?
well, people are looking to generate yield in different ways, right? You have the Joe consumer or boomers like myself who maybe in their retirement account want to have some exposure to Bitcoin. If you were to go out and talk to RIAs, many of them would say, hey, once they're the right types of instruments out there, yeah, 1% allocation to Bitcoin makes sense. You can look at whether it's stuff that Fidelity has written or stuff that other investment advisors have written. Then as you start going kind of down, or rather up the risk curve, you get people who want to trade. So, they don't want to trade in and out using an ETF. They want something with a little more juice. So they might want to use MicroStrategy because of how MicroStrategy uses their balance sheet to buy and hold Bitcoin. Or they may want to invest in miners, or they may want to play the futures markets, whether it's perpetual futures. So the more variety, the more options people have, the more interest there is in the market. And the more liquidity there is in the market, the more investors it attracts. And so this is only just going to add to the liquidity. The other important factor here is it's going to make Bitcoin kind of the unassailable king of cryptocurrencies. It's going to be really hard for any other cryptocurrency to get near Bitcoin's attractiveness as an investment asset, I think. And it's really just going to start snowballing on itself over time, but it's going to take time. It doesn't happen overnight. These things take a while, to kind of get into systems. You still see some brokers haven't quite got them in their systems. Vanguard has said they're not going to offer these ETFs. If you go to JP Morgan, for example, you have to have a conversation with somebody to get them to kind of enable this for you. But over time, what you're going to find is more and more of the traditional brokers are going to let you do this. Charles Schwab, Fidelity, they already let you do it. So, it's very much open season, I think, for these things. But what you are seeing is, as relates to the price of Bitcoin, there was a run up in Bitcoin price leading up to the announcement. Then it's kind of been selling off on the news. Part of that is also people rotating. You have some people rotating out of Bitcoin into ETH because now they're trying to, run up the ETH ETF rumors and see where that goes. I personally think that ETH is going to have a much harder slog becoming approved as an ETF, just due to Gary Gensler's perspectives on ETH not being as clear as they were on Bitcoin. Plus, there's no lawsuit driving him to do anything there. So I think that Bitcoin is going to be the king here. It's going to take a while, but I think that clearly towards the end of this year, we'll see the real impact of the ETFs.
I kind of agree. I think Ethereum might have a little bit more of a struggle ahead just because there's more uncertainty around its classification, whether it's a security, whether it's a commodity. There's much more clarity with Bitcoin. And still the SEC had to be taken to court to approve these things. So, and you mentioned these different broker dealers. It seems like Vanguard was more of like a philosophical stance against Bitcoin, whereas these other ones, like you said, it just takes time for them to offer a new ETF product. And a lot of them they need to see several months of performance before they solicit it to their clients. So it just takes time, like you said. Another thing that might take time to really see the true impact was the newly approved FASB rules. But I know that you're kind of bullish on their impact, at least long term. For anyone who doesn't understand, right now the way Bitcoin's treated from an accounting perspective, it creates a lot of impairments to their balance sheets, the way that it's treated. Do miners have to deal with that too? I assume just because you guys are corporations, you guys have been impacted by these accounting rules. What do you think is kind of the long-term impacts of these changes?
Well, it's only good. Historically, the Marathon has always had to impair its Bitcoin if the price of Bitcoin has dropped, and we've never had the opportunity to reevaluate it upwards when the price has gone up. So we're one of the early backers of this FASB change. We're definitely going to be one of the early adopters here, and start using it this year as a way for reporting how we hold our Bitcoin, which also makes it very more attractive for institutional investors, because institutions need to be able to mark to market the assets that they're carrying on their balance sheets. And Bitcoin previously wasn't an asset that allowed them to do that. Now they can. So I think you're going to see institutions who want to hold spot Bitcoin on their own balance sheet do it this way. The ETFs
Fred,
obviously are securities.
Adopting those new rules like as soon as this year. I know they're supposed to go into full effect like late December, but can you guys technically do that sooner, or how does that work exactly?
Yeah, my understanding is we can start doing it effectively this year. There may be an ability to report your 2023 full year numbers using this type of accounting methodology, but don't take my word for it because that's not my area of expertise.
Yeah.
But definitely this year.
Awesome. Well, that's just another kind of tailwind potentially for the institutional adoption of Bitcoin, I would say, as these ETFs kind of help reduce the barriers of entry as well as these FASB accounting rules. Let's kind of change a little bit to what you guys are doing at Marathon yourself, because you had some exciting news. You had a couple large acquisitions. You acquired two operational Bitcoin mining sites, over 390 megawatts of capacity added from subsidiaries of Generate Capital. Congratulations on the acquisition, I guess. But like, why did you guys decide to do this? What was the strategy behind it, and why now?
Well, part of our strategy has been to shift from our asset light model where we only use third-party hosting to
Hmm.
go to more of a blended portfolio approach where we have kind of a mix of self-mined and third-party hosted. Uh, Using the third-party approach is great when you're growing quickly because you don't have to invest any of your capital in infrastructure. You're just investing it in miners, and that's how we were able to scale from under 3 exahash to 23 exahash very, very quickly. That works great also in an environment where the price of Bitcoin is constantly growing because you're not really worrying about your hosting cost as much. Going forward, though, we want to be very optimized in our cost structure. And so part of that has to do with lowering your operating cost on a per Bitcoin mined perspective, because energy cost is energy cost. It's hard to control that other than through the efficiency of the miners that you use. And Marathon today is already one of the most energy efficient miners there is out there.
Oh,
Our
wow.
fleet on average is about 24 joules per terahash, which is considerably lower
Wow.
than the industry average, which is over 30. But our operating costs at the sites, because we were using third-party operators, they were earning a margin, obviously, on our operations, and we needed to have the ability to really uh, optimize how the miners are run on a daily basis. And as you look at kind of the tail end of 2023, you can see how our monthly performance and our efficiency at the sites, where we were able to go in and tweak how operations ran, dramatically increased the amount of Bitcoin we were producing. In December, we produced over 1,800 Bitcoin, as an example.
Wow.
By far the largest amount of Bitcoin ever produced by a publicly traded miner. So, in doing these transactions, we add essentially 390 megawatts of owned capacity. We're currently using about 60 megawatts of that capacity at the uh, site in Wolf Hollow. And we have used historically some of the capacity at the Kearney site. But most importantly, this gives us net essentially 330 megawatts of additional capacity, which we will over time fill with our miners. There's other people mining there currently. And as those hosting agreements roll off, we will take those shelves, if you would, and make them our own. So this is all part of our roadmap to getting to 50 exahash of capacity by the end of next year.
Well,
And we believe that now is the time to consolidate the industry. Many miners you see are out there buying miners. The problem is they need to have shelves to put them on.
yeah.
And if they're developing sites, those sites can take 18 to 24 months to develop. Look at Riot; they're still developing Corsicana, and that is a huge site. It's going to take them a couple of years to develop it. Some of our other colleagues in the industry, CleanSpark, they've ordered lots of machines. They need to have places to put those machines.
Mm.
Our belief is that you have to own capacity first, and then you can go get machines. And so we're very focused on buying capacity. That's what this deal was all about, 390 megawatts of additional kind of capacity. And you're going to see us continue to consolidate and acquire more capacity here, especially after the halving, when we think a number of miners will be in trouble because the price of Bitcoin is clearly not at a place where post-halving miners are going to enjoy good profitability. And that strain that low Bitcoin yield is going to put on those miners' balance sheets are going to mean some of them are going to have to find options as to how they're going to survive. And part of that is going to be selling the sites that they're running their miners in, possibly.
Yeah.
And if there are attractive deals out there, we will be an acquirer. We're unique in that we have, close to $1 billion of cash and Bitcoin in our balance sheet that we can go and use to go acquire things before we have to dip into our equity. So I think we're in a very good position to consolidate the industry. Our intention is to, continue to grow. We've stated 50 exahash as our goal for the end of 2025, but that doesn't mean we have to stop there.
Yeah, you mentioned like a lot of these miners are buying these ASIC machines, the most efficient ones in preparation of the halving. And you mentioned your fleet efficiency is one of the best in the industry already. It's surprising to me that you said like now is the time to consolidate because, like you mentioned, I figured that would happen after the halving, where you see a lot of these miners in trouble, they get distressed, like you mentioned, but you're kind of getting ahead to seem to get the capacity first and in preparation. And I actually did. There was a great report from Cantor Fitzgerald a couple months ago that looked at all the different miners, kind of comparing them. And I did notice that Marathon had a substantial amount of cash on hand. And so, is that kind of a strategy like to prepare for the halving? Is that you guys want to be in a strong position to be an acquirer, and you just see that as an opportunity? So you're kind of getting a lot of cash now in preparation for that. Is that the idea?
Well, so we run our business from a perspective of we need to be resilient, meaning we need to be able to weather whatever storm comes at us. And
Hmm.
if the price of Bitcoin, let's just say it drops to 30,000 at the time of the halving, not many miners are going to be able to operate profitably. And how many miners have enough cash on the balance sheet to be able to survive 6 to 12 months, maybe 24 months before it becomes profitable to mine again when Bitcoin has moved back up? So you need to have a lot of cash on your balance sheet to do that, because if the price of Bitcoin drops, the Bitcoin you have on your balance sheet is going to lose value as well.
Right.
And if you've just placed big orders for miners, you're going to have cash to pay for those orders at a time when you will be not having a lot of cash on your balance sheet. So we believe that now is the time to buy capacity because these deals take time to close. And this Generate deal was a deal that we did very quickly, very efficiently. We started working on this just before Thanksgiving. We closed it last week. That's a speed that you need a very seasoned M&A team to be able to execute with. And thankfully, our team has a lot of experience in M&A. That doesn't mean we're going to stop doing deals post the halving. We're just getting started. The question
Gotcha.
right now is you want to buy quality sites. You want to buy sites that have all the attributes that make them attractive. So, for example, if I have to go and buy a site, no matter how low cost, that is fully occupied with somebody else's miners, and those contracts are going to run for 4 years, and those miners are going to be in economic trouble, and let's just say the power cost at that site isn't very attractive, then I'm not going to want to own that site regardless.
Hmm.
And I certainly don't want to buy people's machines that are running at a site because all those machines are old. Marathon is known for always buying machines at the bleeding edge of the technology curve. We're very technology focused. We're technology fully vertically integrated, even to the extent that we helped and funded, Auradine, which is the U.S. designer of Bitcoin mining ASICs. And full disclosure, I sit on the board of the company. The idea there was to design a miner that was built for industrial scale miners like ourselves, where you can tweak the performance of individual ASICs, where you can overclock, underclock, where you can manage them to profitability points and do things you can't do with these standard shoebox miners built by people like Bitmain and others. And so we think it's all about being at the bleeding edge of the technology curve, but you have to be able to do that while paying, reasonable prices. But it by no means am I in the market to go buy S19J Pros, for example, today, no matter how cheap, because come the halving, they won't be profitable to operate.
Yeah.
And
Doesn't
so
make
it's
much
all
sense.
about you want to buy the most energy efficient machines so you get the advantage of running them while everybody else is still on the old generation. So let me give you an example. If I have 1 megawatt of power, or let's just say 20 megawatts of power, which is kind of the 1 exahash of capacity today using S19 XPs, right? Operating at about 21 joules per terahash.
Hmm.
If I all of a sudden replace those machines with machines running at 15 joules a terahash, which is essentially what the new Auradine 3 nanometer machines that'll be available at the end of this year will operate at, I can increase my capacity by a third without using any more energy,
Wow.
right?
A
That same
third?
20 megawatts is now, yeah,
Wow.
because it goes from 21 joules per
To
terahash to
15.
15,
15, yeah.
right? So now I've got an extra, essentially 6 megawatts of power that I can use, which is roughly a third, right?
Wow. Yeah.
So, right. So now I can grow my capacity without increasing my energy consumption, which means my cost basis isn't going up. in my mining. And so, a lot of people get this wrong. They think I'll just buy the lowest cost machine and mine with that. It's not how it works. You need the most energy efficient machine that you can get out there. And, we're seeing a whole generation shift. Think about it. The S19J Pro 30 joules per terahash came out in 2020, 2021, right? Was available for shipment.
Mm-hmm.
Then the XP came out. It went from 30 joules a terahash down to 21. The XP started shipping. Marathon was one of the first buyers of that. We placed an order for 70,000 machines at the end of 2021. Those are now all fully deployed. Now you have the T21s, the S21s that are operating at 19 or 17 joules per terahash. Those will be delivered to people over the course of this year. Well, the Auradine machines will be delivered towards the end of this year, and they're at 15 joules per terahash. And at the end of the day, in a tight environment, it's the miners who have who are in the bottom 25% of cost to mine a Bitcoin that will always survive. And so our goal as a miner is to be in that bottom quartile cost-wise, because our technology is so good. We're able to optimize things by running our own pool, and our pool outperformed all of the FPPS pools in December.
Mm-hmm.
And we don't bring in third parties to that. And, it's running our own firmware all the way down to the bottom of the technology stack.
So efficiency is the name of the game, is what you're saying in Bitcoin mining. And how those machines turn over quickly, and part of that's like Moore's law. And some people think it's kind of slowing down as it's getting harder and harder to fit these transistors on there, to double them every single time. Do you see that slowing down over time in terms of the new powerful machines, more efficient machines coming on the market? Or is that not what you've seen in the last couple of years, like you mentioned? How do you see that playing out?
Well, so use the numbers I just mentioned. So the S19J Pro was 30 joules a terahash. 2 years later, the XP came out. That was at 21 joules a terahash. So that's a 30% reduction, right? Then the S21 came out, which is 17 joules a terahash. So that's, about a 15% reduction. Now you have the Auradine machine at 15 joules a terahash, right? That's a further 15% reduction. So you're starting to get to a place where there's kind of diminishing returns. And what becomes more important then is the total cost of ownership. And this is where the Auradine machines, and I know it sounds like I'm touting their horn, but I am, are so good. You can run these machines and target a profitability point, right? So you can essentially say, hey, I want to maximize my profitability. The operating system of these machines will then take into account the current price of Bitcoin, your cost of energy, and the global hash rate. And will tweak ASIC by ASIC, the underclock, overclock, so that it maximizes profitability, all without the operator having to do anything.
Wow.
Now, that lowers your cost of ownership. Other benefits, the miners that we deployed, for example, in our UAE site in Abu Dhabi, this is a full immersion system that's running in 115, 120 degree Fahrenheit average temperature during the summertime. It's very humid, 95% humidity. How do you operate efficiently there? Well, when we did our pilot, we had 1 megawatt worth of miners running for over 100 days before an engineer had to open a container to go look at them.
Just completely by itself.
It just ran all by itself. So that means that you need very few people at these sites to run them. So that's two important takeaways there. One, you can run very large sites with very few people. And more importantly, you can also run very small sites economically because you don't need any people. And so that opens up alternatives that let you operate and grow your capacity without having to look for utility scale hundreds of megawatts, right? It's hard to find sites that have 200, 300, 400 megawatts of capacity. They take time to build, they take time to permit, they take time to get approved by the utility. But there are lots and lots of sites that you could run that are 10 megawatt, 20 megawatt. And then when you start looking at energy harvesting, which is another thing that we're doing, where we're taking methane gas, we're taking biomass, converting it into electricity, converting that electricity into Bitcoin, then using the heat from that Bitcoin production and feeding it back into an industrial process. Now you start getting to a point where you have nearly zero cost energy. And this becomes really interesting. Now, granted, it's a lot harder to scale a bunch of 1, 2, 3, 4, 5 megawatt sites into a gigawatt of capacity. But over time, it makes you the lowest cost operator in the industry. And so I think that's what you're going to start seeing in the Bitcoin mining world is you'll see the utility scale guys operating these very large sites, and then you'll start seeing more and more of these energy harvesting solutions where people are heating buildings with Bitcoin miners, they're heating factories, they're pre-treating parts of industrial processes using the heat, and then getting paid for that. And that subsidizes their energy costs, which makes their cost to mine Bitcoin even lower. So I think it's a very exciting time of transition in the industry. We're going to see much more real industrialized machines being built, not these shoe boxes anymore, but blade-based machines where you have tanks that are have high density, and it's really exciting what we're going to see over the next 2 or 3 years.
Sounds like it. Sounds like a ton of innovation, and just I get excited thinking about these things running by themselves with basically no labor costs and basically free energy. What that means, if you just kind of think far out, it's mind blowing, honestly, what that could enable. I I wanted to bring up something which you brought up the site that you're building at the UAE with 02, backed by Abu Dhabi's sovereign wealth fund, first large scale immersion Bitcoin mining operation. But there's been some FUD out there recently that the average Bitcoin transaction wastes a full swimming pool of water. And from my understanding, water is pretty scarce there. Have you seen that new FUD come out from that research report about Bitcoin waste water? And what would you say to that?
Well, for one thing, for that to be true, you have to use water in your Bitcoin mining. We don't use water. Our systems sit in self-contained tanks of oil. The oil isn't lost or consumed in any way, right? It's a fluid that is pumped around. So think about how an automobile radiator works, right? You've got a sealed closed loop system where radiator fluid is floating around the engine, cooling it, and then it goes into a radiator that essentially cools the heat, and then it goes back into the engine. That's the way immersion systems work. We don't use water. We don't use water cooling at all in these systems. This is 100% self-contained, closed-loop, oil-based systems. Traditional air-cooled mining sites don't use water either unless you have a water wall. And we don't use water walls in any of our sites. So, we have no water consumption at our sites other than the drinking water and the water in the potties that the people on site use. So, you can't measure that on a transaction basis.
Right. So, yeah, for anybody who's wondering about that FUD, I thought that'd be a good answer to look back, and maybe we'll clip that. I wanted to bring up the concept of decentralization in mining. I think it's the most important one of the most important topics to discuss. We just saw actually the Texas grid come under pressure from some kind of storm, and 25% of the hash rate actually turned off. A lot of them have these power purchase agreements where they have with the utility provider, they have contracts in place where they turn down their miners, give the power back to the grid in times where the grid needs it. But 25% was kind of shocking to me about just how much of that hash rate has moved to Texas. And it's better, after the China ban, I think it's better because property rights are respected in the United States of America and there are benefits, but still 25% seemed like a large number. Are you concerned at all about the concentration of hash rate in the United States or just in general? What are your thoughts around this topic?
So handful of things. For one thing, I don't think it's 25% of global hash rate came off. It's 25% of US hash rate, possibly.
Got it. Okay.
You got to realize the US in total represents under 40% of global hash rate. So what you would be saying, if 25% of global hash rate came off, almost over half of the US would have shut down. And there's a lot of mining outside of Texas. I mean, as a miner, we're pretty diversified. We have Texas, we have North Dakota, we now have Nebraska, we have UAE, we have Paraguay as well. I don't think there are many US-based public miners that are as diversified in their locations as we are, either domestically or internationally. And that's by, on purpose. We're purposely diversifying our locations. Yes, there is a lot of capacity in Texas, but that's because Texas is a very attractive market because of how it works, that you can bid for power, that you can get paid for shutting down, all of those benefits. You've got to realize the alternative for the grid operator, when they have a lot of intermittent power, which is solar and wind, you get these winter storms. When it rains and there's wind, the water freezes on the propellers of the wind turbines. And obviously the sun doesn't shine. So they have huge power drops because, upwards of 30+% of the power in Texas comes from these sources. So they need a demand response system that works well. The alternative would be that they either have to turn on a bunch of peaker plants, and oh, by the way, I believe Berkshire Hathaway is an owner of very many peaker plants in Texas, or you'd have to have huge battery systems. The peaker plants only are in business when they can charge $5,000 a megawatt for power, which is what happens in these peak times. And battery guys, if you're investing in batteries, you're spending almost as much on the batteries as you do to build a whole solar farm, which is upwards of $2 million a megawatt. So Bitcoin miners are the ideal solution for the grid because the grid operators don't have to pay anything for the ability to turn off the miners other than they provide a subsidy in the form of a lower cost of energy. And so as a miner, if you agree to curtailing, then you're most probably, entering into an agreement where you're most probably curtailing up to a max of 20% of the time. And in return for that, you get a lower price of energy. And what that gives the grid operator is, hey, I can shut off a gigawatt of demand instantly. I mean, within 10, 15, 20 minutes and keep my grid balanced because my generation capacity is falling off. And then as that generation capacity comes back on, or as demand drops, you now can come back online. So it is a very unique model. And in UAE, we do the exact same thing. We have a relationship with EWIC, which is the primary energy utility. And they have this asymmetry in their demand. Summertime, they need 4 gigawatts. In the wintertime, they only use 1 gigawatt. But they have to keep using the power generation because of how they desalinate water. It uses heat from the energy generation. And so in the summertime, when they've had peak times, they're now able to call us and say, hey, we need you to curtail. They operate a nuclear power plant and they operate gas-fired plants. Neither of the two are easy to regulate the amount of energy they produce on a short-term basis. If you know days in advance, yes, you can increase or decrease the power generation. But if you all of a sudden have a transformer somewhere down the line that goes, and now you have an imminent power outage, the only way to increase supply quickly is to curtail demand somewhere. And so we provide that curtailment in UAE, which has been very helpful to the grid operator there. So, Texas has that unique nature, the way the power markets work. In Nebraska, there's, limited need for curtailment. When there's a requirement, we curtail. In North Dakota, where we're operating primarily on wind energy, same thing. We curtail when and as needed. And, I think any miner who is a good corporate citizen is going to do that. But we do provide a very valuable service to stabilizing grids. That's, the key message here.
Got it.
Now,
I always thought it was a cool use case. Yeah.
The second part of your question, the second largest mining country in the world is Russia today and growing. Why? They have lots of nuclear capacity with no offtake. And so sovereign nations today are very interested in mining Bitcoin. Why? The US weaponized the US dollar. And so if you as a sovereign want to hold your reserve assets, you don't have many options. The US dollar historically has been the reserve currency of the world because it's a safe haven and you could trust the US to not mess with your dollars. That's not the case anymore. If you're a commodity producer in the Middle East, for example, there's risk that the US may put you on an OFAC list. And then what do? Now you can't move money. They may take your reserves like they did with Russia. And I'm not saying they're going to do that with a Middle Eastern country necessarily. But, you can look at all these central banks that have been buying gold as a way to hold their reserves instead of dollars.
Record amounts.
You can go Google this, record amounts. And so now you also have sovereign nations looking at Bitcoin as an alternative to the dollar. The problem is if you're not mining your own Bitcoin and you don't have your own pools, then the US, through its OFAC process, could block you from accessing markets and getting your transactions mined. Look at what some of these pools out there are doing now, where they're being rumored of filtering based on OFAC compliance. And full disclosure, Marathon had a pool operating 3 years ago where we had that capability, which we shut down because there was such an outcry from the industry. So the risk for censorship is very high. And so you see nations like UAE who want to operate their own Bitcoin mining, who want to have their own custody, who want to have their own pools, etc., because it gives them sovereignty over their assets, just like most Bitcoin owners today want to have sovereignty over their financial assets. And so one of the key driving purposes behind Bitcoin is self-sovereignty. Well, nations want that. And so now you're starting to see nation states want to mine specifically for that reason. Bhutan, 200 megawatts of power, right? And growing. Middle East, lots of countries there very interested in it. Russia's doing it. You're now starting to see countries in Africa looking at it. You're starting to see nations in Central and South America. So I think what you're going to continue to see is more and more diversity in who's mining. You're going to continue to see hash rate grow because there are people who don't necessarily have a financial profit interest in Bitcoin mining, but have a strategic interest in Bitcoin mining. And they're going to continue to invest in mining. Plus, they control oftentimes their own electricity costs, so they can essentially mine for free. So I think you're going to continue to see global hash rate grow. You're going to see capacity growing on a global basis. You'll see the US share of global Bitcoin mining decrease over time. The other thing you're going to see is a growing number of micro miners. And this gets back to the energy harvesting thing I mentioned earlier. The ability to mine Bitcoin and heat a building at the same time, mine Bitcoin and grow shrimp, mine Bitcoin and heat hothouses. It doesn't need a lot of mining capacity to do that, right? You're paying for the energy anyway. Why not mine Bitcoin? About 95% of the heat that or energy that you buy to plug a miner in is converted into heat when you mine Bitcoin. If you can capture that heat and use it for something else, think about it. People pay a lot of money to heat buildings. People pay a lot of money to heat greenhouses. There are industrial processes that need low-grade industrial heat for food processing, other things like that. So there are lots of opportunities for people to use small capacity Bitcoin miners to heat things. And so you're going to see a growing amount of hash rate. It'll be very slow at first, but over time, you'll see it grow to be a significant share of mining that is micro miners doing simple things like heating, where mining Bitcoin is really a byproduct of what they're really doing. And that's something I'm super excited about, because there you can really talk about decentralization of Bitcoin mining.
Yeah. Micro miners. I like that. There was that Reason TV documentary. I don't know if you saw it, of the bathhouse in New York. I don't know if you saw that. Yeah. So that heat reuse, I mean, the possibilities there are endless, like you mentioned. I love what you just said in terms of these nation states beginning to get into Bitcoin mining and how they control their electricity costs. Doesn't really bother them to mine a loss when they're doing it for geopolitical reasons, to protect themselves from seizure and their assets getting confiscated essentially. And I just think about, is that the kind of the answer to some of this centralization at the pool level? Is like, should we see more pools start to develop from these nation states who want to use their own pools? Is that kind of one possible outcome here that could improve the decentralization at that mining pool level? And why haven't we seen that already, where we see these larger like Russian pools and other things come online?
So there are lots of reasons for, one is you as a miner need to have enough capacity such that you're evening out the luck effect, if you would, of mining to operate your own pool. Why do you point your miners at F2 or at Foundry or one of those pools? Well, because they pay you just based on your contribution of hash rate, right? It's an FPPS pool. So I point an exahash of capacity at that pool. I'm going to get whatever my pro rata share of the winnings of that pool are. The problem is you're sharing with everybody else. And so if you're a big enough miner, you actually want to have luck factored into your winnings. So if you think about when all these ordinal transactions happened in May and then again in November and early December, when we mined all these Bitcoin, because we operate our own pool, we got to keep 100% of the odd blocks that had all of a sudden 6 Bitcoin in transaction fees, 7 Bitcoin in transaction fees, in addition to the block subsidy. Had we been in an FPPS pool, we would have been sharing that across the pool.
Oh, okay.
And so, in our case, our pool outperformed, Foundry or F2 by a considerable percentage. In the case of many miners, they want the cash flow because they have to pay electrical bills. So they want a check, essentially. They want to get Bitcoin every day from their pool operator so they can, know exactly what
Makes
they're
sense.
going to get so they can pay their bills. As you look under the covers a little bit more, what you'll find is there are miners who essentially got their operations financed, and then pools who got their operations financed by deep-pocketed operators in the space. And if you look at kind of the flow of Bitcoin from many pools, you'll see that Ant Financial, for example, has been financing many of these pools because FPPS pools have to pay out based on pro rata share, regardless, even if the luck factor runs against them. And so for
Got it.
many pool operators, it's a very risky business to be a third party pool operator. So that's kind of the reason why I think that, you're going to
Yeah.
start seeing more and more people start mining with their own pools, but they have to have scale to do it. And so, how many people have more than 10 exahash of capacity? Up until recently, there weren't very many people that had that type of capacity.
Yeah. Yeah, it makes sense. I mean, when I think about the consolidation that might occur over the coming year too, I think even less people will probably be able to have it, right? So it's interesting. I think it's like a topic that should be talked about a lot in terms of, how do we further decentralize this network at every single level? I mean, you brought up, being an ASIC manufacturer in the United States. That's another kind of choke point in terms of centralization at the ASIC manufacturer level. And so it's a good thing. It's a good thing to come up with these solutions, I guess is what I'm saying. I was wondering, you brought up how acquired those new operating sites and as a way to kind of diversify your operations. I've heard other miners kind of try to diversify their revenue streams by going into other things like AI and other sources of computation. Are you guys planning to do anything like that over at Marathon, or are you just strictly, Bitcoin focused?
So our philosophy at the high level is we're asset allocators, right? So we have
Mhm.
capital provided by our shareholders, and we need to be really good custodians of that capital. And so we need to invest it in the things that we think are generate the best return for our shareholders. We have studied AI, and being a boomer here, I've been in tech for 40 years. I started my career writing software on punch cards in banks, on old IBM 360
So
mainframes,
cool.
which gives you an idea of how old I am. Granted, I was in high school at the time, but and I have developed technology that was, Ethernet technology that was core for the original internet build out and the build out of all these PC connected LANs and WANs. Built token ring technology, built switching technology, saw the internet grow, was involved in ad tech, game tech, all these industries as they've grown.
Wow.
And the one thing, and I was a big, contributor to some of the early IoT stuff over 20 years ago. The one thing I've learned is never invest in the first generation.
Hmm.
And what you have going on in the AI space relative to data centers today is you have this race to build capacity to do LLMs, large language models, and inference. And what people are doing is they're taking the state of the art processor and building these data centers around these GPUs. So the H100s, typically the NVIDIA product. And so the challenge with these HPC AI sites is that the GPUs need to be interconnected. So if you have a cluster of GPUs, every GPU needs to be connected to every other GPU for it to work properly. It's the way the brain works. right? You have neurons that connect everything. And that means that you can't build a field of containers that's flat, because the distance from one container at one end to the container at the other end is going to be longer than the two containers next to each other. And so you need symmetrical connections, same length. And so you want to build these data centers almost like spheres. And so it's like a 3-story building that's 3 stories wide, kind of, right? That's the ideal way to build
them.
these.
They're very
Right?
symmetrical. Yeah.
So building a data center for AI is 8 to 12 times more expensive than building a data center for Bitcoin mining. The only thing they have in common is they both need lots of energy. Period. End of story. Right? The other thing is the H100s. Now let's talk about the technology curve. H100 was the hot machine, 12, 18 months ago. Everybody's ordering them, right? What does NVIDIA do? They launched the H200, right? Look at what the hyperscalers are doing. They're not buying H200s. They're on to the next generation. A lot of them are developing their own systems. So if you're going to operate a data center for AI, you've got to be thinking about 99.99999% uptime, 5 nines, right? You've got to be thinking about, how do you cool these things? You can't immerse an H100 or an H200 in oil. You've got to liquid cool them by cooling the individual chips. Now you are using a lot of water, by the way. If you then start looking at the operation of these sites, it's very people intensive. This stuff breaks all the time. And you've got to have a really fat internet connection, right? Because it's big data. This is high velocity, high volume, high resolution data that's got to get connected here. It's not a couple of Starlinks on a remote site somewhere that's burning methane. These are totally different businesses. And so I think any Bitcoin miner who says we're going into AI and we're going to be the best at this, it's going to be a flash in the pan, because they don't have the CapEx to be able to finance machines where the obsolescence is going to be every 12, 18 months for the next 5 years. So I wish them luck. I wish them luck, but I've been in this industry long enough, the tech industry long enough to know that if you get involved in the hype curve, you're going to crash into the trough of disillusionment before the business really starts working. And we're going to see so many improvements in vector databases, which increase the efficiency of these systems by 100-fold, which means, guess what? You need 100 times less compute power all of a sudden to do the same thing. And as this technology curve continues to advance, look at what happened to PCs, right? What was the way that Intel built their business? They invested in software companies that made software that needed CPUs to be more and more powerful, because otherwise there was no need to buy new CPUs. What is NVIDIA's business model? It's selling chips and software. How do they sell more chips and software? Well, they find new ways to sell new chips and software, which means the people installing a lot of this stuff, it's not going to last them 5 years. It's not going to last them 8 years. They're going to be obsolete in 18 months.
Yeah.
And the CapEx, like I said, is 8 to 12 times more expensive than Bitcoin miners. So I think that you really need to be careful as a Bitcoin miner about going down the rabbit hole of HPC, because it's going to be a very short-term project for you, I think.
Yeah, I didn't know anything about like the differences between the businesses, or those details. So thanks for sharing that. That's fascinating. So I wanted to just end with just some general like Bitcoin over the next 12 months. I mean, you mentioned that Mara is one of the largest holders of Bitcoin itself. So I have to think you guys are at least partially positive on the future direction of the price. What do you think about? What do you think about the 12 months? Because I mentioned FASB, mentioned ETFs. There's a macro backdrop that one could argue is supportive of asset prices if the Fed does cut rates. What are you looking at over the next 12 months with just Bitcoin's price?
So I think you got a number of really good tailwinds. You've got obviously FASB, you have the ETF. You have the halving, which granted it's more of a psychological shock than anything else. As a supply shock, you're talking about going from 900 Bitcoin a day to 450 Bitcoin a day. There are millions of Bitcoin traded a day. So that supply change isn't going to really do a whole lot, but it's the psychology of it. But there are only ever going to be 21 million Bitcoin. We've mined almost 20 million. The amount of Bitcoin actually in circulation today, liquid on exchanges, is somewhere between 1.8 million to 3 million, depending on the day. And what's going on with the ETFs, that liquidity will increase likely. But realize a lot of these ETFs, once the Bitcoin goes in there, if somebody's buying shares and somebody is selling shares of the ETF, that Bitcoin doesn't have to circulate anywhere on the blockchain. It's just going to stay in the ETF, like in a corporate wallet at an exchange. And so, there will still be very tight supply. So between all of those tailwinds, there will be demand increase and price will go up. And as you start getting sovereigns who want to hold more Bitcoin, we talked about they want to mine Bitcoin so that they can get their transactions processed. But, listen, there are only about 1 million Bitcoin left to be mined between now and 2140. So no sovereign is going to build up a whole wealth fund by mining their own Bitcoin. They only want to mine Bitcoin as a way to transact and be able to transact Bitcoin and process transactions. They are going to have to go in the open market and buy Bitcoin. So I think as you add up all these things, there's reasonable logic that supports an argument where by the end of this year, we should hopefully, and this is my personal opinion, it's not Marathon's official opinion, and this is not financial advice. My personal opinion is that I think we will exceed the prior all-time high by the end of this year. There'll be a sell-off, profit taking, and then you'll see by the end of next year, we'll exceed that all-time high by potentially 2x. And after that, who knows what's going to happen? Bitcoin may repeat its traditional cycles and go into a bear market, or we may be done with bear markets and it's really a macro environment where it's all about global liquidity. To your point, global liquidity will increase this year. I don't think we're going to see inflation fully tamed this year. I don't see the Fed doing max maybe 3 rate cuts. You're not going to see recession across the broad economy. You'll see pockets of recession. The PMI is down, for example, but consumers are still spending. You're seeing housing coming back now as interest rates are, real interest rates are dropping. So I think the economy is going to be a mishmash of signals, but global liquidity will increase. China's about to do a trillion yuan liquidity injection. You're going to see Europe cut rates faster because their economy is in much worse shape than the US's economy is. And you're going to continue to see disinflationary areas of the economy, energy sector, for example. But you also have geopolitical risk, right? You got all the craziness going on in the Middle East. You've got stuff still going on in Ukraine and Russia. And you have the risk for China, Taiwan. So all of that means that the US fiscal spending is going to have to increase. There's nobody putting look at what Washington, the Senate just approved today, a spending bill that the House will likely approve. That is 1.6 trillion. I think it's a stopgap measure. The fiscal spending in the US is out of control. And when you've got $33 trillion of national debt that, oh, by the way, in Bill Clinton's day, he was the last president to have a surplus in the budget. The national debt in Bill Clinton's day was $5 trillion. Right? It's $33 trillion today. Right?
So
the
crazy.
General Accounting Office estimated at the end of Bill Clinton's term that if that budget surplus continued, the national debt would be paid off in 15 years. Yet today it's ballooned to $33 trillion. Right? There's only one thing the US can do to control that debt, and that is either stop spending, which doesn't get anybody elected, or do something that lowers the value of the dollar, that lowers the cost of servicing that debt. And what does that bode well for? That bodes well for Bitcoin.
Bodes well for scarce assets, and nothing's more scarce than Bitcoin. I agree completely. Like the idea that, one of the biggest bear cases for Bitcoin is this austerity measures, it makes me even more bullish, because it's really hard to see these politicians Sunday like waking up all of a sudden and saying, "Oh my gosh, look at these deficits this is crazy. We got to cut this back." It's actually the opposite that we're seeing. They're continuing to run multi-trillion-dollar deficits. It's hard to have a recession when they're still keeping these liquidity conditions like this, and it's only, it's probably likely going to increase. We just saw Christine Lagarde actually just say she expects to cut rates by summertime. The market's now expecting 6 cuts by the Fed. The market's been wrong before on that stuff, but it just seems like the messaging has changed over the last about month. So I think you're right. I think we're in for a couple wild years. Price predictions are, impossible to, be accurate with, but it is exciting to think about where this goes, and it's hard not to see Bitcoin reaching all-time highs over the next couple of years, given these conditions. Fred, thank you so much for coming on the show and sharing your expertise with this stuff, especially on the energy side. It's always helpful for myself and the listeners to kind of hear from experts like you. Where can they find some of your work, or if they want to learn more about Marathon Digital Holdings? Where do you want to point listeners to?
So for Marathon, it's mara.com, mara.com. And by the way, keep a lookout. We're about to release a short film called Path to 23 Exahash, which kind of tells our story in video form, which was a lot of fun to put together. And I think the audience will appreciate watching that. So that'll be released on the 23rd of January. So keep a lookout for that. You can reach me on Twitter at FGTHIEL, or on Telegram at the same address at FGTHIEL.
Awesome. Well, thanks, Fred. Thanks again. I guess have a wonderful, hopefully, weekend coming up. I know you got another day left here, but thanks for coming on. Really appreciate it. And I will hopefully see you soon.
Absolutely. Look forward to it. Thank you very much.
Thanks. Well, I always love talking to Fred. He always brings a very, intelligent approach to his perspectives on the markets, as well as, he's an operator. He's on the ground. He's building. He's a leader of one of the largest publicly traded Bitcoin mining companies, and you don't get there without being an experienced operator as well as leader. And he talked about his path through the technology industry through decades, and so to have him in Bitcoin, I think, speaks volumes to this technology. To have somebody like him who has worked in all these different groundbreaking technologies, and he's decided to spend his time and energy on this new monetary technology that is Bitcoin. So thank you, Fred, for coming on. I hope you guys enjoyed it. Like, subscribe, comment, let me know what you think. Another really exciting episode lined up. We're gonna look at the Bitcoin venture capital world with a couple of VCs next week. So I'm really excited about that. And so tune in at the Swan Signal Live next week. I was your host, Sam Callahan, and I am out. Thank you.